Hi everyone, welcome to the mortgage market tip for March 2011. It's Mortgage Rob with Invis. Hope everybody's having a great month. Some amazing events in the last week or so with the earthquake in Japan and all of the video and it just actually it's breathtaking. And unfortunately, I mean it's hard to believe having to go through something like that. So my thoughts and well wishes go out to anybody who may have any family or relatives that are involved in such an event. What I wanted to chat about really quickly today is just a couple of the quick market updates. Regarding interest rates. Interest rates actually have been coming down a little bit in the last little while. We're seeing some lenders after the big increases last month doing a little bit of jockeying. So we're kind of back under the range of less than 4% for a 5-year term, 5-year fixed term again. Part of that is due to the stock markets, and basically, the Nikkei index in Japan as well as the TSX has come off a little bit, which creates the bond yields to drop as well, which then in turn also allows the banks a little bit more room on their interest rate. So that's very good news. Last month, the Bank of Canada made their announcement. They kept the prime rate the same, did not move the overnight rate. Mark Carney, in his announcement, spoke of Canadian debt levels remaining. They're kind of coming. They're not increasing as much as they were, which is a good thing, and they're more in line with the growth of household income, which is good news. So that kind of talks that we maybe the effects that the changes in the mortgage market are going to help overall. He also talked about a more subdued economy, that the growth in the U.S., while is good, is not better than what was originally forecasted, so it's given them some leverage in order to keep interest rates the same. So unfortunately, with some of the recent events that we have, it's unfortunate on the personal side and the lifestyle side, but on the interest rate front, that should actually assist in kind of keeping interest rates at bay for a little while. So that's sort of, relatively good news. In regards to the changes that CMHC made, and the biggest one being the amortization changing, that change is in effect on March 18th this week. Overall, to date, we've seen basically every lender for high ratio mortgages is going to be decreasing from 35 to a 30-year amortization, but what we didn't know was what was going to happen on the conventional mortgage side. That's for putting 20% down or more. It's kind of a 50-50 split right now. What we're kind of seeing is that the larger institutional lenders like Scotiabank, TD Bank, First Line, they are also changing their conventional financing from 35 down to 30. But some of the more niche lenders, some of the mortgage lenders are still offering some extended amortization. So there's still some options to get up to as much as 40 years on a conventional mortgage. Not that's the best strategy for a client, but it is available. One of the things that this affects is the overall ability to qualify for a mortgage. And while we've seen the amortization shrink, we've also seen some other more aggressive ways to qualify for certain types of financing with using rental income, and there's been some lenders change some policies on that in the last little while. So there's still some really good options. It is complicated to know really what your options are going to be when you're looking to qualify for your maximum mortgage, so don't hesitate to give me a call if I can be of any assistance. Remember, my service is free. My fee gets paid by the bank, so I'm here if you need any advice for either yourself or any loved ones. Hope you have a great month, and we'll talk to you in about 4 weeks. Bye for now.